Good morning, everyone. Welcome to the Baker Institute Energy Forum. We're very pleased to have you here this morning. We have a new study to discuss, and we have a fantastic opening lineup of speakers. Thinking about this topic and the fate of our current oil supply and the price being above $125 a barrel, it makes me think to when I first came to the Baker Institute. I arrived here in 1996 to help organize a study on the Persian Gulf and energy security. At that time, the oil market was stable. People believed that an orderly clearing of any kind of supply shortage could be handled easily by the futures exchange. We were just coming off the experience of 1990 when we lost 5 million barrels a day of supply and markets jittered for a few weeks and then came right back down. People thought that that was proof that markets could easily handle any kind of supply crisis that might come up. Now, I must confess, at the time, the market was so stable that some members of the Rice faculty advised me not to get too settled at Rice. They said that I should start right away looking for my next job because there was no need to have an energy policy research program in the academic world. Obviously, they were incorrect. We knew that in 1996, and the study we did concluded that we actually were very vulnerable to a major oil supply disruption. And I'll read a quote from that study. While the U.S. should be and is prepared to deter and defend against external aggression in the Gulf, we must also assess what the U.S. can and should do in the face of generational and regime change in the Gulf and in Iraq. So that was very prescient in 1996. We said that the threat to energy security might come from internal rather than external factors, and that the U.S. and its allies need to look beyond military issues to the emerging situations of economic, political, social, and cultural change inside the countries of the Persian Gulf, with special consideration given to the role of religious groups. And the study called on the things you would have expected us to say about promoting privatization, political reform, and broader participation in the economic system to diminish the role and manifestations of social injustice that give rise to extremism. We also recommended the U.S. intensify its central role in advancing the Arab-Israeli peace process. Well, today, almost a decade later, the same issues loom large, and we are gathered here in the context of unstable oil prices, rattled financial markets, and a plethora of geopolitical risks, which we have been busy analyzing as academic scholars. There is a lot of work for major oil-consuming governments to do in the area of energy and climate security. We are just beginning to see more political will, even here in the United States, but we have just begun to scratch the surface of the kinds of changes that are going to be needed. I know that the U.S. Congress's response to this year's Memorial Day gasoline price run-up, the suspension of the small fill rate to the Strategic Petroleum Reserve, is discouragingly meek. But there are good ideas circulating that could be effective in reducing risks that we face, and in this context, we present today a major energy study called The Global Energy Market: Comprehensive Strategies to Meet Geopolitical and Financial Risks. The surprising outcome of this study is that even as oil prices climb, some of the key threats to market stability that stimulated the so-called terror premium in the first place are actually starting to ameliorate. Iran's recent elections are a signal that international sanctions are starting to work and that the country's internal politics might be signaling a change in direction. In today's news, Israel confirmed it was having a constructive dialogue with Syria. And as our study will highlight, some of the risks facing the energy market today may actually be less catastrophic than they seem at first glance. One silver lining to Ambassador Region's absence today is that I get to thank our sponsors directly myself. Ambassador Region apologizes for not being here today. They had a death in the family, and he is in Europe. But we really appreciate all of your being here today and we so appreciate the support we have received for this project from the Institute of Energy Economics of Japan and from our Baker Institute Energy Forum. My good friend Ken Kayama is here from the IEEJ, and we appreciate all the support and friendship we have enjoyed with his organization over the last decade. I would also like to thank the British Consulate for their assistance in today's program. Moreover, I cannot emphasize how important our Energy Forum members are to the success of this program. We set our goal to have a policy program with analysis and recommendations that were realistic and sound. Our Energy Forum members have made a personal commitment to help us meet that goal, not just with their support, but also with their expertise and experience and their active participation in our seminars and conferences. I would also like to thank the Shell Foundation for their generous and ongoing support for the Shell Distinguished Lecture Series. This lecture series is the mainstay of the Baker Institute and has contributed greatly to the dialogue on important matters that face our world today. I'm very excited about today's program. Our keynoters represent the best brain trust we have here in the United States to forge better policies. I want to thank them each personally for taking time out of their busy schedules to talk to us today. I think when you hear their formal comments, you'll understand how in demand their insights must be from the U.S. government and other groups around the country. So with that, it's a great honor for me to introduce our opening keynote speaker. He is our Shell Distinguished Lecture speaker today. For those of you who aren't economists, it's hard to articulate just how important Martin Feldstein is in the smooth operation of the U.S. economy. I had the honor of visiting his organization, the National Bureau of Economic Research, this past winter, and I left the discussion there with great new insights. Martin Feldstein is the George F. Baker Professor of Economics at Harvard University, and he is the President and Chief Executive Officer of NBER. From 1982 to 1984, he was the Chairman of the Council of Economic Advisors and President Reagan's Chief Economic Advisor. He served as President of the American Economic Association in 2004. In 2006, President George W. Bush appointed him to be a member of the President's Foreign Intelligence Advisory Board, and he is a member of many important societies, including the American Philosophical Society, the Econometric Society, and he's a fellow of the National Association for Business Economics. Well, I could go on and on and on because his credentials are so long. So let me just tell you, he's a Harvard man and hails from Oxford University. That's a powerhouse of combination. Thank you very much. Marty, please come up.
Thank you very much, Amy. I'm delighted to be here to participate in this important conference and pleased to have this opportunity to talk about the U.S. economy, our financial markets, and some of the implications of the high and rising price of oil for our economy. Let me begin by stressing my very positive long-term view about the U.S. economy. Although we do have some structural long-term problems, particularly associated with financing the programs for Social Security and Medicare, I think that the U.S. basically has a very strong and effective economy. We have an adaptive and highly motivated labor force. We have strong entrepreneurial spirits. We have capital markets that support new ventures. And although we all complain about the burdens of regulation, when I compare the regulatory burdens of the United States with those of other countries, I think that we are in significantly better shape. And all of that contributes to a high and rising standard of living. I wanted to begin by emphasizing my long-term positive views of the economy because my remarks today are going to focus on the near term, and they are going to be more negative. The situation in the U.S. economy today, in my judgment, is bad. It's been getting worse, and there's a risk that it could be very bad. I believe, and this is definitely my personal view, not that of the National Bureau of Economic Research, that we are sliding into a recession. Each of the major economic indicators that we see month to month peaked in December or January and has been coming down since then. February was a terrible month. March, we got a bit of a reprieve, and the statistics for April are again quite negative. Essentially, every major indicator of economic activity is lower now than it was when the year began. Although the economy has been declining, there are those who are optimistic, who think this is a temporary pause in our expansion and that by July or August we'll see the economy growing strongly again. And they point to three things. They point to the lower federal funds interest rate brought about by Fed policy. They point to the tax rebates, which are now beginning, and they point to the lower dollar, making our exports more competitive. And it's certainly true that all three of those are positive factors for the economy, but I doubt that they have enough power to keep an expansion going. Think about the lower interest rates. The Fed funds rate, the overnight rate, has come down from 5% to 2%, but the mortgage rates are no lower today than they were a year ago. I think in the current context of housing market collapse and dysfunctional credit markets, monetary policy does not have the traction that it did in the past, is not capable of bringing an economy back up. The fiscal stimulus package, $100 billion plus checks in the mail to American households, will clearly help for a couple of quarters, but it's not clear that it will help beyond that. Moreover, you have to bear in mind that a $100 billion increase in cash to households is offset by an increase of $30 billion of $30 a barrel in the price of oil. And we've seen over the last 12 months, as you all know, double that increase. So this only offsets half of the drag on personal incomes, on real incomes of the U.S. economy that has come from the increase in oil over the last 12 months. And finally, although the lower dollar helps and our exports are improving significantly, exports are only 7% of U.S. GDP. So even a substantial proportional increase in exports doesn't buy us very much. This downturn is really quite different from previous downturns. We've had 3 of them since 1980, and each one of those was caused by the Federal Reserve tightening monetary policy, pushing real federal funds, real overnight interest rates to very high levels in order to stem inflation. And then when the Fed felt that it had done that adequately, it reversed direction, lowered those interest rates, and the economy could expand again. This time was different. The Fed did not precipitate this downturn by pushing up real federal funds interest rates, and therefore it can't take us out of it by simply reversing direction. Instead, the problem today was caused by the events in the housing market and the credit markets. And the interaction of these two, of housing and credit markets, could lead to a very severe recession, worse than any we've seen in the post-war period. Now, let me be very clear. That's not a prediction that it's going to happen. Don't go away and say, I heard Marty Feldstein predicting that this is going to be a recession worse than any we've seen for 50 years. No, what I'm saying is that there is a significant risk, a risk that I think ought to influence economic policy and private decision-making, a risk that we could have a much deeper downturn if there is a downward spiral of house prices. And I'll come back to the reasons for thinking that that could happen. Let me explain what I think is happening in our housing market and its impact on our credit markets. Housing starts are down nearly 40% from a year ago and more than that from the peak. But the major problem is not one of construction, nor is it just a subprime problem. It is spread throughout the housing sector. The housing problem represents an unprecedented combination of 3 things: an explosion of house prices in the first half of this decade, very high loan-to-value ratios, and the securitization of mortgages. House prices increased between 2000 and 2006 by some 60%. Relative to affordability, relative to costs of construction and rents. So we had a bubble in house prices, and the inevitable consequence of that had to be a decline of house prices, and that began in the middle of 2006. Since the peak, house prices nationally, on average, are down about 20%. This man is leaving to sell his house. Are down about 20%, and the experts say that just to get back to a normal level will take another 15% fall in the price of houses. We have seen in the last 12 months house prices falling at 13%, and that pace is accelerating. Let me say something about loan-to-value ratios, because that's critical in this story. Traditionally, the loan-to-value ratio on a new mortgage, on a house purchase, would be in the 70 to 80% range. But in the early part of this decade, creditors were prepared to take on mortgages with 90% or even 100% combined mortgages relative to the value of the home purchase. They were prepared to do that because they saw house prices rising so rapidly that in a year or two, what started as a 90 or 100% loan-to-value ratio would become an 80 or 90%. And so they felt comfortable that this was not excessive exposure, and that worked. It worked in the beginning of the decade when house prices were indeed rising very rapidly, but it stopped working once house prices stopped rising and started coming down. And the result is that loan-to-value ratios, instead of falling on existing properties, began to rise. And we now see a substantial number of homes with loan-to-value ratios greater than 100%. That means individuals whose mortgages exceed the value of their homes, individuals who have negative equity in their homes. There are now about 8.5 million such homes in the United States. It's almost 1/5 of all of the mortgages. It represents about $1 trillion of mortgages in which individual mortgages exceed the value of the underlying real estate. And as house prices continue to come down, we will see more and more homes being pushed from positive equity into negative equity. In general, these mortgages are no-recourse loans, so the creditor can take the property if the individual defaults, but cannot proceed beyond the property to other assets, to bank accounts, to wage and salary income. So negative equity homeowners have an incentive to default. Now, the past experience is that Americans have not defaulted in large numbers when they had negative equity. But I think conditions now are quite different. We're seeing a much more widespread national situation with, as I said already, 8.5 million homes with negative equity. The losses are greater, prices are expected to fall, and I think there are changing social norms which may make it more acceptable for people, especially when they look around the neighborhood and see large numbers of other neighbors who are defaulting and moving out of their homes. And if they don't know how to do it, they can go on to the internet where, believe it or not, there is a website, youwalkaway.com, which tells you how to default. And if you think it's a joke, try it, youwalkaway.com. So the problem is really a very serious one in which declining prices and increasing loan-to-value ratios are pushing more and more homes into a negative equity position. And this is exacerbated by the fact that homeowners cannot negotiate with the creditors who hold their mortgages because such a large fraction of all mortgages have been syndicated, have been securitized, so that there really is no creditor on the other side of the mortgage. I think that the greatest risk that our economy faces in terms of an economic downturn is the risk of a downward spiral of house prices as individuals are pushed deeper into negative equity with the incentive to default on those loans. We've had foreclosures last year of 1.5 million homes. This year it's running at twice that rate. And so we're going to see more and more real estate put on the market, adding to the existing stock of real estate and putting downward pressure on house prices. No one can know how far house prices are going to fall as long as there is this overhang and this process, this dynamic in which houses are defaulted upon, foreclosed, and added to the stock of homes for sale. And as mortgages lose value, the financial institutions that hold those mortgages see their capital shrinking. That hurts their ability to lend, and in the end could push them into insolvency. And as individuals see the value of their homes declining, their wealth is falling, and that in turn cuts into their consumer spending. That brings me to the credit market problems. Situation in the U.S. credit markets now is worse than I have ever seen. There are some indications that some aspects of those markets are getting better, but large parts of the credit markets are still dysfunctional. And the cause of that, the fundamental cause of that, is the inability to price mortgage-backed securities. The key to the credit market problem is these mortgage-backed securities and the derivatives based on them. And the value of those securities cannot be established with any confidence as long as there is this risk of a downward spiral in the price of houses. None of the actions of the Fed, nor the proposals of the Treasury, nor the recently agreed upon package of support that the Senate Banking Committee has agreed and that the House has passed, none of that deals with this problem of a potential cascading of downward movements in house prices as homes move from positive equity to negative equity, pushing down the price of homes and leading to further declines. I've proposed a plan for mortgage replacement loans to reduce loan-to-value ratios for those who now have positive equity in their homes, now have loan-to-value ratios of less than 100%, as a kind of circuit breaker or firewall that would prevent an increase in the number of negative equity homes as the price of houses fall. I must say I can only hope at this point that now that the Senate and the House have acted on plans to deal with those mortgages that are already underwater, or with some of the mortgages that are already underwater, and have found a basis for bipartisan agreement in the Senate and with the White House, I think that there is a chance that they may now turn to what I regard as the more severe problem of the millions of homes that will be pushed from positive to negative equity, adding to this downward pressure on house prices. Let me say a few words about inflation. Inflation is basically still a neglected problem in Washington. For the Fed, all of the focus is on the recession and the credit markets, and inflation is a problem they expect to come back to after a recovery begins. But inflation is rising. The consumer price index was up 4% in the last 12 months, and powerful forces are driving inflation higher. Food, energy, of course, commodity prices more generally are increasing dramatically, driven by demand from the developing countries, but also by the decline in interest rates, which adds to the speculative demand. More generally, as the dollar has come down, that is added to the cost of our imports, and the higher cost of imports has fed into inflation. Not surprisingly, inflation expectations are rising. The most recent household survey was very worrying in that regard. Most recent household survey shows that American households are expecting that over the coming year, inflation, consumer price increases will be some 5.2%. 4% is the actual number for the past year. The Fed's target is to be under 2%, and the American households are looking at more than 5%. So there's a real danger that increasing inflation expectations will feed rising wages and will push up, therefore, other prices. Let me say a bit about the dollar. I think there's no subject more confusing maybe except oil, than the dollar. The dollar has been declining significantly over the last 5 years. It's been declining at an increasing rate in the last 12 months. I believe the dollar decline will continue. The fall in the dollar is a natural process of correcting our overvalued dollar. It's a natural and necessary way to shrink our very large trade deficit. There's really nothing wrong with the U.S. becoming more competitive in global markets. And a lower dollar relative to our trading partners is the key way in which that can happen. The dollar is being driven down by a variety of factors. One of them is the interest differential between interest rates in the U.S. and interest rates on comparable securities in Europe. You can get a higher rate of return on a euro government bond than you can on a U.S. Treasury bond, so it's not surprising that both governments and private investors are shifting portfolios from dollars to the higher yielding and appreciating euros. In addition to that, the expected weakness of the U.S. economy is adding to the downward pressure on the dollar. But the most fundamental reason, and the reason why it's going to continue to be a sustained process of the dollar becoming more competitive, is that we have still an enormous trade and current account deficit. The decline in the dollar in the last 5 years has helped. As I said earlier in my remarks, our exports are up significantly. Our trade deficit has come down from 6% of GDP to 5% of GDP. But at 5% of GDP, it is still an enormous trade deficit. It requires the rest of the world to absorb some $700 billion of additional dollar securities to finance that trade deficit each year. In contrast, Germany has a current account surplus of some $250 billion, Japan over $200 billion, China $250 billion, and so on. Only a more competitive dollar can shrink the U.S. trade deficit by making U.S. products more competitive in global markets and making foreign products more expensive here at home. The fact that the dollar has been coming down for the last several years does not mean that the dollar is weak. In fact, the dollar is strong. The dollar is too strong. The dollar is too strong in the sense that we have an enormous trade deficit because U.S. goods and services are priced in dollars in global markets at an exchange rate that makes them less attractive and therefore generates this $700 billion trade imbalance. So I believe that the dollar is going to continue to fall. We'll see it continue to come down this year and beyond, relative to the euro, relative to the yen, relative certainly to the Chinese renminbi, which made further adjustments in just the last few days. It's now at 697 or 696, so a real significant reduction, but also relative to the other Asian currencies. Let me repeat that this, in my judgment, is not a cause for concern. It's a natural way for the U.S. trade deficit to be reduced. And the reduction in the dollar and the increase in exports that it brings about couldn't come at a better time, given the general weakness of the U.S. economy. Let me conclude by commenting very briefly on what I see as some of the impact of high and rising oil prices on the U.S. economy. And then I look forward very much to questions. I see we have microphones in both aisles here. As you know, in the past 12 months, the price of oil has increased $60 a barrel, doubled. U.S. consumers, or the U.S. economy as a whole, consumes petroleum products of about 7 billion barrels a year. So the cost of oil to the U.S. economy has gone up by $420 billion, about 4% of disposable personal income. And that implies a major reduction in consumers' real incomes and a continued low household savings rate, a savings rate now in the United States that's about zero. The high price of oil has also led to an increase in the cost of other energy products and indirectly to an increase in the cost of food commodities because of the ethanol program and other ways in which high prices of energy lead to higher food commodity prices and therefore to higher food prices. And these high rates of measured inflation will also induce the Fed, once it gets through the current recessionary period, to move toward higher interest rates in order to bring down the rate of inflation, so that at best we will, as the economy begins to expand, see a contractionary federal policy which will slow down and reduce the strength of that expansion. A less obvious impact of the higher price of oil is on the dollar. Because petroleum imports to the U.S. are some 4.5 billion barrels a year, at the current price of oil, our imports are some $500 billion of oil products. The $60 a barrel increase in the last 12 months means that the cost of our imports is up by $250 billion. That's 1/3 of the entire U.S. trade deficit. So the dollars that we pay for that imported oil leads to an increase in the supply of dollars in the global market, and that pushes down the value of the dollar. That in turn, as I've already indicated, leads to increases in inflation in the United States, and it could also contribute to a higher price. It would also contribute to a higher price of oil measured in dollars. But the more competitive dollar at the same time also helps our export industries. Well, let me conclude by simply saying that as I look ahead, I think this year and 2009 are going to be very difficult years for the U.S. economy. Much depends on what happens in the housing sector and whether the downward spiral of house prices that I fear is avoided. I hope that I'm being too pessimistic about that risk, but I'll be a lot happier if Congress and the administration can begin to deal with the risk of a downward spiral in house prices, allowing the Fed then to focus more on preventing a new round of higher inflation. Thank you very much.
Well, I would run out and call my stockbroker, but I told Dr. Feldstein that I would organize the question and answer session, so I'll take my chances. If you please would, because we're webcasting, there's many more people watching the conference actually at their computers. If you have a question for Dr. Feldstein, please come up to the microphone.
You've been intimidated.
He sounded so smart. Come on, here we go.
You take the point that the housing prices are too high, so they have to fall. So if you're going to have some program that's going to sort of slow that down or prevent it, I mean, ultimately, if they were overvalued before, they are going to have to fall at some point. So it would seem like the only alternative, if the house prices aren't going to fall, is that you have to have general inflation elsewhere to build our house prices back to what would be a correct level. So I guess one question: do you see that process unfolding if indeed there are proposals to slow down the rate of decline? Second point, I guess, is I'll just ask. You've got the new administration coming in. What would be your number one policy advice how to handle the situation?
You are right that house prices have to fall further unless the general price level goes up. I certainly am not advocating an increase in inflation. I think that would be a very bad way to get out of this. We saw in the late 70s and the early 80s what damage an inflation spiral can do. But there is an alternative. What matters is not the price of housing, which you're right has to come down another 15 or 20% just to get back to a normal level. What can be done in order to stop the loan-to-value ratios from going up is to change the character of the loans. And that's what I've proposed. This mortgage loan replacement idea is a way of taking part of the mortgages, having the government take part of the mortgages and convert them into to loans from the government with full recourse, so that individuals would not have the incentive to default. So it would convert the mortgage part of their obligation, the mortgage part of their loan, to a much lower loan-to-value ratio. And therefore, prices could fall 15 or 20% without it pushing people from positive to negative equity in their homes. So that's my way out of this, and I hope that the Congress and this administration will act on it before a new administration comes to town, because between now and a year from now, by the time a new administration could put together such a package, we would probably see another 15% fall in house prices. That 15% fall in house prices would push roughly another 8.5, 9 million homes into negative equity. We would then find ourselves with 40% of mortgages underwater. So they can't move too fast, in my judgment, to get this problem resolved. Yes, sir. I can hear you.
Okay, Forrest Ralph with the gas price report. About the savings rates and what happened is, because you could get a tax benefit by borrowing against your house, people kept raising their loan values and taking money out of what they perceived to be their equity. That has exacerbated the problem once the market had something like 1929. Low margin requirements, and we're buying fixed assets. Moving the tax benefit on mortgages and doing some other things to increase savings, like stop taxing savings so that not play this mortgage game.
Well, I think your diagnosis is exactly right. I think there's no question that people took advantage of the opportunity, not just because of the tax rules, but particularly because of the very low interest rates that were available in the early part of the decade to refinance, to do home equity loans. I would not take away the mortgage deduction because it's built into the price of houses. And so you would see very significant capital losses to individuals if you took away that. We do have a number of programs in place that have been put in place over the last couple of decades: IRAs, 401ks, Roth IRAs, all kinds of ways of increasing saving. I think if we move toward a mixed funding system for Social Security, adding personal retirement accounts on top of the tax finance part, that would help a lot, because we would increase saving, real saving, from the entire population. But beyond that, I think that saving will start to increase spontaneously, even without changes in legislation, simply because we're not going to see the positive effects of household wealth, making people feel they don't have to save. We're not going to see people refinancing homes. So I think the natural tendency toward higher saving will take over. There's a familiar face. Good to see you.
Hi, Marty. A question, what are the implications of this somewhat negative outlook for the U.S. stock market and for foreign stock markets over the next year and a half?
That's too tough. That's too tough. Even a question from an old friend as tough as that, I don't think I can really answer. I think one of the things, the stock market to me has been surprisingly high. One of the things that's keeping it high is the profits earned in foreign subsidiaries and foreign branches of U.S. corporations. When they get translated from euros and yen back into dollars, even if there's no increase in the euro level profit or the yen level profit, there's a 15% increase in the dollar value of that. And I think the stock market is looking at those higher profits as if somehow there's something real going on, something that's going to continue to go on in that way. I think if the economy turns out to be soft, it's hard to imagine that the stock market won't reflect that to some extent.
Okay, last question.
Yes, I was quite surprised that you didn't mention, although oil is one of the, high prices of oil are one of the reasons or one of the explanations of the recession, it's by far not the main, as you seem to indicate. And indeed, such high oil prices over such a long period of time seem to have had a remarkably little impact on the U.S. economy. And as we, since this has been going on for such a long time, presumably the impact will be less in the long term, at least, in terms of the U.S. economy adjusting to using less oil. If you could elaborate on that a little bit more for us.
So I puzzled along with others when the price of oil went from $30 to $60 and $70 a barrel, why that didn't have the kind of negative impact on our growth that we'd seen in previous periods when the price of oil rose. And I realized that by accident, it was happening at a time when individuals were also being incented to do the kind of mortgage refinancing, extending the amount of mortgage credit that they had, and taking those mortgage loans and using them as a bank account from which to spend. And we saw the savings rate come down from 2.5%, 3% to essentially zero today. That's not sustainable. And I think that as the price of oil stays high, we're going to see a swing back in the savings rate because of the reasons that I said, with people's wealth being lower, with the opportunities for mortgage refinancing not being there. I think we will see increases in the household saving rate, and it's the household saving rate rather than business saving that has been the primary drag on our national savings rate. Well, I enjoyed the questions, and I enjoyed being with all of you.
Thank you very much. Okay, we're going to switch gears a little bit now and think about national security. Every time I talked to somebody in the last couple of weeks from the U.S. government and I said that Dr. Thomas Fingar was coming to keynote our conference on global risk, every single person I mentioned that to said that he was the smartest person in the U.S. government. No surprise. He is our first Deputy Director of National Intelligence for Analysis, and serves concurrently as the chairman of the National Intelligence Council. He, I think, participated actively in that controversial New York Times Iranian assessment. So any of you have questions on Iran, he'd be a good one to ask. He was selected for this position while serving as Assistant Secretary of State at the State Department's Bureau of Intelligence and Research, the INR, and has a variety of very important posts in the State Department. He began his career as a German linguist, so a lot of range, and he has worked a lot on Chinese issues and so forth, so he comes with a very varied resume, and we look forward to having him here with us today.
Thank you, Amy. With that, that introduction, I'm afraid I can only disappoint. I want to thank Amy and the Institute for putting on this program. It is important to address these issues and address them recurrently, that even though energy has not been central to my own career, it's been a more or less consistent strand since the early 70s. And I'd like to make a couple of observations before looking at some of the geopolitical risks, specifically sources of instability in the Middle East. That in the early 70s, when I was looking at Russia, I was in my academic phase. I spent almost 2 decades at Stanford. Began to attend a number of conferences which articulated views of the energy world, if you will, more than markets, where energy was produced, how it was transported, consumed, that straight-lined in a remarkable fashion and were almost always wrong. My own more deeper involvement began after a friend, Sig Harrison, published a book, you may recall, from 1975, I believe it was, China, the Next Oil Giant. How China was going to gain incredible geopolitical influence as a major supplier of oil. The book displayed the hazards of drawing a trend line through a single data point and enabled me to make a minor career of saying, I don't think so, academically. In order to counter what Amy said, a little dequalifying statement, in the early 80s, I was the American co-chairman of something called the U.S.-China Energy Policy Working Group. Among my Chinese counterparts was a man named Li Peng, who went on to become premier. He succeeded more in his system than I did in ours. I've always attributed that to us not having a prime minister. With that as background, I want to do a little bit of scene setting, big picture, broad brush dimensions of the global market, the global situation, narrow in on the Middle East, and then pull back briefly to the global picture because they all interact. That my job today is easy. I need to be descriptive. Others have to be prescriptive. What do we do about the situation that has been described? That following Marty and his demonstration of why economics is called the dismal science, I may come off as a little bit more Pollyannish. But I think what both he and I want to get across is there are an awful lot of moving parts in this situation. This is an equation that has many, many factors, and changes in any one of them affects possibilities, affects probabilities, affects options, and affects the efficacy of the options that are chosen. Let me begin with a statement of the patently obvious. We're in a period in which both demand and prices of energy are going up. And take that a step further to say, so too is global dependence on problematic sources of energy. That the location of oil and gas, primarily, happens to be concentrated in areas of the globe that one can summarize as problematic, whether it is Iran and Iraq, Venezuela, Nigeria, Sudan, Russia, that there, of course, are the primary suppliers to the United States, Canada and Mexico, which are not in the same category, but it does color United States and American perceptions of the situation. We are not nearly as dependent on the more problematic sources as are our primary trading partners, as are the BRICS, Brazil, Russia, India, and China, that we have a different view, we have a different timeline, understandably so. Our stake is different. Just say a few sentences about some of the countries, the source locations, and the dynamics that are at play. Russia. Russia is clearly using the windfall profits from high energy prices to accelerate its return to major power, major player status. There are positive elements of this: increased self-confidence, increased opportunities for investment, increased engagement in the international economic order, and there are some downsides to it. But for starting point, there is at least a concern in some circles that Russia's use of the energy tool, energy leverage vis-a-vis Europe, will make Europe more dependent on, responsive to, a Russia that is becoming arguably less democratic, more authoritarian. To state all of these is to overstate it, in my judgment. But I learned when I made the switch from history to political science decades ago that perceptions are often much more important than facts. And what I have just described is widely perceived as a problem, as a challenge, as something that needs to be dealt with, rather than as a fact of life in the energy market. Live with it. Venezuela. In the grand scheme of things, Venezuela is not among the most important sources of oil, but it's very important to the United States. And Hugo Chavez, the president, arguably has a disruptive agenda. He seems to go out of his way to tweak the United States, to cuddle up to other problematic countries, Iran, North Korea, and his friendship with Cuba, that again, the perceptions exceed the reality. But it colors choices about investment, about choices made by other consuming nations, about the operation of the market as it deals with a problematic country because it has a problematic leader. Sudan. Again, not a major supplier. But because it has got such a terrible human rights record, because of the high profile of Darfur, of the civil war that raged in the south for decades, it's become kind of a litmus test, a touchstone in an argument that is, why would you buy oil for an oppressive regime? You can extend this on to Nigeria or Burma. They're less bad. Burma's worse. Nigeria's less bad. But why would you enrich the coffers of a repressive regime, enable it to remain in power, just because you need the oil? Well, we don't buy any oil from it. It's a freebie for us. Some of the come later into the market consumers, here China primarily, because that's who invested in and buys the oil from Sudan, that China ought to cut back on its oil consumption in order not to empower the regime in Khartoum. Again, perceptions that run contradictory to operations of market forces, that are short-sighted. If anybody's oil comes off the market, everybody else's oil becomes more expensive, and there are ripple effects. Let me use this as a segue into the Middle East, which I've asked to focus on here, where the factors and the dynamics that affect stability also affect geopolitical risk globally, not just in the region. And let me begin with Iran. Iran is a regime which is problematic, not just to the United States, to the region, to Europe, to Asia, for a lot of reasons. Let me just point to some as illustrations. The nuclear program. Mention was made by Amy of the estimate that we did on Iran's nuclear program. There is no question that Iran seeks the capacity to make fissile material. If you can make it for a power plant, you can make it for a weapon. It believes it has a right, as a treaty member, to a fuel cycle for peaceful uses of nuclear power. Peaceful at some point is in the eye of the beholder here. If Iran were not perceived as a problem, the nuclear dimension would be perceived differently. But it has become a touchstone issue that is very, very difficult to work, and the ability to work that issue is compounded by its status as a major supplier of oil and gas. Support for terrorism. Iran has adopted kind of a two ends of the spectrum approach to dealing with more powerful states that it regards as threatening. United States, first and foremost, puts Israel on the list, but it has others. The nuclear, having a nuclear deterrent, seems to be a good idea if you're a weak state living in a hostile neighborhood, which Iran does. The other end is the poor man's nuclear deterrent, which is terrorism. You can't protect all your people everywhere all the time. Mess with me, I will go after some of the 4 to 5 million Americans not wearing uniforms who are outside of the United States any day, and the trillions of dollars of American investment that are outside of the United States. And it isn't simply a hypothetical threat. They support Hezbollah. They support extremist Palestinian groups. And they have demonstrated their willingness to use terror. The high price of energy, the increases that Marty described, have brought, of course, windfall profits to Iran, bolstering its capabilities and its confidence. Tehran thinks it's on a roll. Can point to some of the factors that bolster that assessment. Saddam is gone. Saddam was their #1 enemy. It used chemical weapons against them, used missiles in a terror way. A Shia regime has been replaced, a Sunni regime has been replaced by one dominated by Shia co-religionists. The Taliban are gone. The threat that they faced in the East is gone. Again, they didn't have to remove it, but they benefit from it. Hezbollah, in the summer of 2006, that stood up to Israeli military force arguably more successfully than any Arab government had ever done. They didn't win, but they certainly emerged as a client of Iran with demonstrated capacity, and they need to be taken seriously. And much of the discussion and debate in Lebanon right now over the future structure of the government concerns the role of Hezbollah, which is influenced by its patron, Iran, through the intermediary of Syria, to make it even more complicated. Let me do an overlay of some of the considerations, the dynamics that come into play, not in a unilateral reinforcing way, but in cross-cutting ways. And these are in no particular order. One of them is, of course, Arab-Israeli tensions. A dispute which perhaps, like the poor, has always been with us and always will. Certainly hope not. Certainly believe it's possible to have two states living in peace and harmony, but we're not there. And at a minimum, the existence of the current struggle and tension is used as an excuse by nations in the region for doing and not doing things, for tolerance of dealings with Hamas, with Hezbollah, with other extremist groups, for the Syrians for why they need to be with Iran, and so on. It's much too simple, as some of our Arab friends in the region argue, to say that if the Palestinian-Israeli dispute is resolved, all of the other problems would go away, and the rapidly falling dominoes. What I want to get across today is not my judgment. They're independent and they're difficult. The Arab-Israeli conflict and the way it is perceived, and the way the United States is perceived. Are we perceived as a balancer, as an honest broker, or are we perceived as tilting to one side or the other? To the extent we are perceived as tilting to one side, we are perceived as becoming a part of the problem rather than a part of the solution. This complicates our ability to work issues in the region. Arab-Persian tensions. Iran is a Persian nation, long, proud history, culture, acutely sensitive to being different than the Arab culture that surrounds it. And whether one calls these as characterized as nationalistic or chauvinistic, the tensions are real. It's one of the reasons that Iranian-Iraqi differences are probably more important on a nationalistic basis, or Arab-Persian, than they are fellow Shia. The tensions between Arabs and Persians that fuel Iranian security perceptions, one could argue also fuels a degree of paranoia, but there's a reality to it. It's not completely paranoid. And conversely, when the Saudis and the Kuwaitis and the other Gulf states look at Iran, they see a real challenge. It's not something that the Americans are pushing them in a particular position. They see a real difference that is meaningful to them. Sunni Shia, religious differences. Again, been around for a very, very long time. The Iranian Revolution of 1979 that staked out as an objective defending and advancing the Shia. At least one way of looking at what has transpired in Iraq since 2003 is the spread of Shia dominance. The Shia are the demographic majority in Iraq. Sort of democracy brought people into power who had been forcibly repressed by Saddam, by the colonial regime before that. And there is a sense of, we're going to get some of our own back. We need to build in protections to make sure we are not, once again, put in a subordinate position. Now, how does Sunni Shia cleavages interact with Arab-Persian? Very complicated fashion. Remind you that most of the Iraqis who died in the 8-year war with Iran were Shia. They were loyal Iraqis. Increased religiosity. It's a global phenomenon. One finds it in Hindu India, one finds it in the United States, one finds it in Africa, one finds it in the Middle East. It plays into Sunni Shia tensions. It plays into ability to galvanize, mobilize, call to religious activity. In its most extreme sense are radical, jihadi, suicide bombers. None of these sort of dynamics in the region lend themselves easily to a role to United States or outside sort of political diplomatic intervention. We don't have a lot to say about how a population or populations that are becoming more religious, that are wrestling with doctrinal issues, that are working out long-standing historical tensions, should handle these issues. We don't have a lot to bring to the table that doesn't immediately look like meddling, unwarranted outside interference, involvement in a domestic issue. Let me add two more. Demography. Much of the world is aging nations. Japan, most of Europe, Russia, thanks to inward migration, not the United States, but aging populations. The regions producing oil and gas and in the Middle East are overwhelmingly young. Nations filled with raging hormones. Nations filled with young people exposed to the outside world through the internet, through Al Jazeera and other global communications vehicles. They understand much more clearly than any generation ever has sort of what's going on elsewhere and how they fit. They're really educated. Windfall and other energy earnings for a long time have enabled them to avoid the kind of involvement in economic activity that is sort of outsourced to Pakistanis and Egyptians and Koreans and others coming in. But the dissatisfaction level and the no stake in the system dimension across the region is high and increasing. It seems to me to last and concerns the character of regimes. And regimes here I'm using as a political science term, not in a disparaging way. It summarized the polity, the society, the economy, the culture. But as one looks across the region, the myriad problems that I sketched out and more, not least of which is the alienated youth problem, it's hard to come to the conclusion that regimes have a high degree of legitimacy, have a high degree of cushion for dealing with the problems, and are easily able to adapt to the challenges of a globalized world. High energy prices maybe enables them to kick the problem down the road, but the problem doesn't go away. And a little bit lower energy prices can translate very quickly into a much bigger problem. And that's all bring this to a close. None of the dimensions that I've sketched out above are directly energy related. There are some technology, care of the basins, and so forth. But all of them affect stability. All of them affect the array of options that is possible and the way in which they can be brought to bear. And in one of the great conundrums and dilemmas that we faced is that almost any solution that one can dream up to sort of fix the character of regime problem or address some of the others, I think, is almost certain in the near term to have an adverse effect on energy supply in the global economy. And conversely, anything that one can dream up, or at least this guy can dream up, to address the energy situation is going to have an adverse effect on stability in the problematic countries, many of them rich in the United States. So I guess that puts me in the same dismal league as Marty. These are tough problems. Because of the nature of the problems, the nature of the era in which we live, and our own actions over decades, we can't solve these alone. We need the engagement and the involvement of others. And the major energy consumers who have a big stake in the resolution, European Union, China, India, Russia, have a very different stake. It's just to put one small example here, we get, Ruben, I think it's less than 10% of our energy comes out of the Middle East, certainly less than 15%. China and Japan, it's probably closer to 70, 80%. So let's disrupt energy supplies for a while in the Middle East in order to bring about a desired political objective. Or let's apply sanctions that disrupt financial flows. Looks very different depending on how dependent one is on the region. And neither we nor they have the capacity to address the situation alone. So any solution is going to be complicated by the need to involve a large number of important players with very big and not identical stakes. Let me stop there and invite questions.
Okay, very good.
Yeah, I could ask several questions, but my question for you is this: coming out of the Cold War analytical area of government and foreign affairs, asking kind of more of a method question, how well adapted now is DNI to the new strategic environment? How have you shifted to deal with these transnational actors, the people at the low end of the spectrum that you describe Iran using? And to what degree can you hash out for us what the U.S. government is doing in collaborating with others beyond the United States and sharing analysis and leveraging that to build reservoirs of soft power?
It's a good question. It's one that has many parts. Let me just pick out two. One is the shift from a focus on nation states, or in the halcyon days of the Cold War, two camps. That was pretty easy. Focusing on nation states, the end goes up to 193. Focusing on a globalized world in which there are all kinds of transactions, licit and illicit, all kinds of empowered players, from NGOs down to governmental organizations to multinational corporations that are not just in the mix, they're very big players. Many of them are bigger players than our nation states in the equation. We don't have sort of internationally, globally, a very good framework for deciding who are the legitimate players, how is power to be allocated among them, what are the decision rights, what's the governance structure. And where this is leading me is we've had these marvelously successful structures that were put in place after World War II. The United States played a very, very major role both in conceiving them and in implementing them and monitoring them and facilitating them. They arguably have begun to show their age. The permanent members on the Security Council, just to pick one illustration. But the ability to manage the kinds of problems you point to. What's the replacement regime? Who gets to put it forward? We're a very different situation than we were in 1945. The same wide array of different characters are going to have to play, many of whom, the newly industrializing country, India and China, have a very big stake in the status quo. They're doing well in it. Their interest in transforming the regime is somewhat diminished by the uncertainties of change and the certainties that they're doing well. The other is what are we doing with other nations by way of sharing information and assessments. We do a lot, and I think mostly we do it because of who we are as Americans. There's a sort of if we've invested the time, the effort, the money, the large population, the large government that we have that can work on things, that the right thing to do is to share it. There is also the less altruistic. If people understand the analysis that undergirds our policy decisions, they might be more inclined to accept or work with those policy decisions. And there is the reality that the kind of problems we face, global terror being one, where local police forces around the world have information that is a lot more important to us than things we're going to get without reaching out and engaging. The need for the partnership drives this partnership.
Thank you very much.
Okay. Thank you, Amy.
Well, our next speaker is Reuben Jeffrey III. He is the Undersecretary for Economic, Energy, and Agricultural Affairs and serves as the senior economic official at the State Department. Many very qualified people have held that job, but probably none as qualified and fitting the times as Reuben Jeffrey. And that is because he's also been the chairman of the Commodity Futures Trading Commission. He has served in the President's Working Group on Financial Markets. He's been on the National Security Council as the Executive Director of the CPA office at the Pentagon, and he's worked with Ambassador Bremer in Iraq. Before that, he had a very distinguished career in investment banking, stationed in London with Goldman Sachs, and really has a broad range of experience in international capital markets, which, having heard the previous two speakers, you can understand that if we're going to have a senior diplomat flying around for the United States talking about the energy market and the ripple effect of the high price of oil, we would definitely want it to be someone like Reuben Jeffrey. So thank you very much.
Amy, thank you for that very kind and overly generous introduction. I hasten to add that of the three speakers, somebody's got to bring down the average IQ of this morning's program. Look, I also want to begin by thanking the Energy Forum and Rice for hosting this conference and also for the generosity of time and financial resources of the sponsors. It's really a great privilege to be here at the Baker Institute. Secretary Baker is one of the finest diplomats of our time. As you know well, few Americans have served our country with greater distinction. He began his public service career as a United States Marine, served as White House Chief of Staff, Treasury Secretary, and Secretary of State. His breadth of experience is truly remarkable, and I hasten to add that for those of us who have the privilege of acting in public service, Secretary Baker and others like him are real role models and inspirational figures to many of us. This morning, what I'd like to do is outline the State Department's approach to, and the U.S. government's approach to energy areas, in energy issues in three particular areas. First, something that Tom touched on earlier, the challenges of maintaining supplies of oil and natural gas in a supply-constrained environment. Second, international efforts to address environmental quality with a focus on reducing emissions and increasing efficiency. And third, the move to increase the mix of energy sources by developing alternatives. Let's start, and where I'll spend the most time here, and I'll try to be as brief as quick as possible, given the shortness of the morning, with the supply side of the equation. The U.S. maintains a strong focus on maintaining good relations with traditional energy suppliers. Countries like Qatar, for instance, have opened to robust international investment in LNG. The UAE recently deepened foreign upstream participation, allowing U.S. and Japanese firms an important role in an offshore oil field. Kuwait's been receptive to American refinery investment, and we're hopeful that the Kuwaiti Parliament will see the mutual benefits of proceeding with the opening of the northern fields. Saudi Arabia will be investing in additional production capacity and is open to many large downstream investments. From a U.S. perspective, U.S. engineering, service, and energy equipment exporters are an important component of energy exploration worldwide, especially in the larger supplier regions. And they are important for the most significant of all reasons. It's not the money or the capital they bring, it's the intellectual and technical and professional expertise, which we have in this country, bar none, and we should never lose sight of that, not just in the energy sector, but in so many spheres, which is one reason, on the positive side of the ledger, America is so admired for its technical and professional expertise in many parts of the world. As Middle Eastern nations invest in oil and infrastructure projects, American exports to the region have, in fact, risen, and they've risen quite substantially. Africa is another significant energy supplier, with roughly 10% of the world's proven oil reserves. Nigeria and Angola are the largest producers on the continent. Nigeria, one of the top oil-producing countries in the world, not without its challenges, to be sure, but is a major supplier to Europe and the United States. Angola has received significant international investment in its energy sector, and production is expected to reach some 2 million barrels a day this year. It's also a major natural gas exporter. These and other African countries are expected to become increasingly important suppliers to world markets. Now, the energy future for Africa, however, is tied to its overall economic development prospects. It's our hope that the energy sector will be a driver for broad-based economic growth and a prosperous future on the continent. This is a long-term challenge. African countries, the private sector, and governments around the world should all be partners in making this hope a reality. Moving to Russia, which Tom described in some detail, the country is the largest supplier of oil and natural gas to Europe. It's the largest repository of natural gas reserves in the world, and it's the largest non-OPEC producer of oil. As you know, U.S.-Russia ties are vital on a number of fronts. In April, President Putin hosted President Bush in Sochi, where they set forth a framework for strategic cooperation on security and economic issues. A key element of this agreement was to launch a joint economic dialogue. The first such discussion took place in Washington last month, at which energy and other economic issues were discussed. This will be complemented by a business-to-business, CEO-led dialogue with representation from both sides in the months to come. Now, in our own hemisphere, we continue to strengthen key energy relationships. Canada is now America's largest energy trading partner, with energy flowing, in fact, in both directions between our two countries. In March, we hosted Canadian Ambassador Michael Wilson in the State Department's treaty room, where we signed a presidential permit authorizing the Trans-Canada Keystone Pipeline Consortium to construct a pipeline extending some 1,300 miles from Canada through the U.S. Midwest. When fully operational, this will bring some 600,000 barrels a day of oil imports from Canada into the domestic market. We're engaged trilaterally with both Canada and Mexico on energy through the Security and Prosperity Partnership. The U.S. is a net exporter of natural gas and of gasoline to Mexico, but Mexico is our third largest supplier of crude oil after Canada and Saudi Arabia. Another of our key diplomatic goals on the supply side is our ongoing work to diversify global energy production and transportation routes regionally. For example, we are actively involved in Eurasia. This effort, interestingly, began in the days when Houston's very own mayor, Bill White, was the Deputy Secretary of Energy. A hallmark, a signature accomplishment of his tenure during that period was the Baku-Tbilisi-Ceyhan pipeline. We continue these efforts today, working with governments in the region to find outlets for their natural gas supplies that will allow them to meet consumer needs in a secure and reliable manner. Last month, we visited Azerbaijan and Turkmenistan, where I had the opportunity to meet with each of their respective presidents, President Aliyev in Baku and President Berdimuhamedov in Ashgabat, to discuss a wide array of mutual economic issues. In the energy sphere, we discussed the need to deepen east-west energy corridors. In particular, we spoke of bringing additional oil and gas across the Caspian Sea, through the Caucasus, and onto global markets. Ambassador Boyden Gray, the President's Special Envoy for Eurasian Energy, and others of us are making outreach to these and other states in the region a key strategic priority. And I should stress in that regard that it's not all about oil and natural gas, not by any means. As I said with Africa, what we want to do and what we hope to help these countries help themselves do is use the benefits of their energy assets to make a better life for their own people. The United States is committed to working multilaterally to promote greater liberalization and transparency in energy markets through numerous venues. The Group of 8 industrialized nations at the St. Petersburg Summit in 2006 began an ongoing process of focusing the world's attention on core energy principles of transparency, of competition, of open markets to improve stewardship of energy resources. This work continues. Through the Extractive Industries Transparency Initiative and voluntary principles on human rights and security, we seek to make oil revenues more transparent, to promote good governance, and to foster the highest human rights standards. Many of your companies and NGOs are active participants with us in these initiatives, and we thank you for your efforts. Another multilateral fora is the IEA, the International Energy Agency, in which the United States is an active participant. The U.S. and other member countries are working with the IEA to broaden its engagement with major energy-consuming countries, and in particular with the rapidly developing economies of China and India. Global energy needs, if they weren't constrained enough today, are expected to increase over 50% by 2030, with nearly 3/4 of this increment coming from developing countries. Strengthening ties, therefore, with these emerging energy consumers is a priority for an organization such as the International Energy Agency. Now, well, you can be assured that the U.S. is actively pursuing the ways and means to enhance the global availability of oil and gas, wherever mindful of some of the constraints. I've heard no better recent review of those constraints than Dr. Finger's presentation a few minutes ago. A report of the National Petroleum Council outlined what they term the hard truths of global energy supply. For example, investment is critical to energy exploration and production, yet less than 10% of the world's oil and natural gas reserves are open to full equity participation by international energy companies. Another concern is resource nationalism. Energy investments are long-term and require clearly defined property rights, sanctity of contract, and equitable dispute resolution mechanisms. Their absence slows investment flows and sends a negative signal to investors in other sectors as well. Now, in the middle of an unprecedented energy price escalation, many producing countries would be well served by building the legal framework and encouraging the behavioral norms necessary to attract and retain the sort of equity investments that will sustain them over the longer term. Rest assured that we will continue to advocate for mutually beneficial engagement between governments and the private sector in our discussions with energy producers around the world. Let me raise another challenge, underscore something Tom said earlier, to supplies, one that I know is of keen interest to this audience. To underscore the complexity of the relationship between energy and national security, it's important to note that overarching national security concerns can, in some circumstances, lead us to limit our own access to oil and gas. Iran's pursuit of sensitive nuclear technologies is such a concern. Accordingly, your forbearance, the companies, organizations you represent, from doing business with Iran is a vital U.S. national and international security interest. To be sure, Iran is an energy-rich country. We understand that sanctions, including those relating to the energy sector, are not without their near-term costs. But we must weigh those against the unacceptable risk that Iranian behavior poses to the peace and security of the world. Now, the U.S. government continues to make every effort to multilateralize the pressure on Iran. The UN Security Council has passed not one, not two, but now 3 sanction resolutions. We're also actively reaching out to third country financial institutions and energy firms to discourage business as usual, and particularly to discourage investment in Iran's energy sector. We've offered to the international community that P5+1 has offered a package of incentives to the regime to renounce its activities related to the development of nuclear weapons. We certainly hope that Iran will pick up the offer that is on the table and rejoin the global community and the world economy as a responsible participant. Now, let me turn from the oil and gas to a brief overview of a second component of our energy diplomatic outreach, which is to ensure environmental stewardship through reduced emissions and greater energy efficiency. Starting with our own domestic policy, the administration has worked with Congress in a bipartisan way to pass the recent energy legislation specifying a new fuel economy standard, 35 miles per gallon by 2020, and mandating 36 billion gallons of renewable fuel by 2022. The law sets objectives for the coming decade to increase the efficiency of lighting and appliances. In addition, the President announced a new national goal to stop growth in U.S. greenhouse gas emissions by 2025. The effort here is to slow, stop, and ultimately reduce greenhouse gas emissions on a global basis. Innovation is going to be critical to these efforts. Since 2001, the government has dedicated, all of you as taxpayers have invested some $37 billion on science and technology research related to climate change, including $18 billion in research, development, and promotion of clean energy technology. We are working hard to ensure that this research is shared internationally. The President recently announced a $2 billion commitment, it's a multi-year commitment, to a new International Clean Technology Fund. This will be administered by the World Bank and has the support of Japan, the UK, and other countries. The objective of the fund is to bring the best available clean technologies to emerging markets. Now, a third element of U.S. energy diplomacy involves broadening the sources of energy both here and abroad. Alternative fuels are an important component of our energy security. In fact, there's no way we're going to meet that 50% increase in demand that the experts are predicting between now and 2030 without robust development and exploitation of alternatives. Therefore, they're an important element of our international outreach. One effort on biofuels is a bilateral agreement with Brazil to advance ethanol technologies and to help harmonize international biofuel standards and codes. We're further engaged in promoting clean energy through the Organization of American States, where we're supporting a series of upcoming workshops in the hemisphere to help promote renewable energy. In the Asia-Pacific region, we've launched a partnership on clean development and climate to encourage renewable energy projects. So far, over 120 different projects have been sponsored, and we look forward to more in the future. We're also working to pursue the expansion of clean and safe nuclear power. We're working both bilaterally and through the International Atomic Energy Agency to help countries considering nuclear energy develop the national infrastructure necessary to meet the highest standards for safety, security, and non-proliferation. The Global Nuclear Energy Partnership, or so-called GNEP, has 21 countries so far and is working to develop technologies that will reduce nuclear waste while strengthening the proliferation resistance of nuclear reactors. And we have a number of specific agreements and negotiations, discussions along these lines in place with some major countries around the world, including India, Russia, and most recently, Saudi Arabia. These agreements underscore the determination of the U.S. and other countries to expand the base of energy sources. As the international supply-demand equation becomes more challenging, greater efficiency and a broader mix of fuel types will become more urgent. We all recognize that these challenges are worldwide in scope and require a global response with American leadership. In conclusion, I'd simply say that not since the first oil embargo in the early 70s has the global energy security situation been as complex and dynamic as it is today. Economic, political, security, and environmental considerations are at play, sometimes in complementary ways, sometimes in competition with one another. These challenges are both immediate and longer term. Part of the solution set lies, of course, with sound domestic energy and environmental policies, but energy markets are global and require active, constructive, and constant attention by the private sector and governments alike. The long-term nature of the challenges we face require both immediate actions and longer-term investments in oil and gas exploration and distribution, but also in efficiency and alternative fuel sources and types. As government officials, we recognize and applaud the contribution you and all of the organizations you represent can make and are making to our shared energy future. So thank you for your attention and for being at this conference.
Questions?
Quick question. Thank you very much. A very interesting presentation. In the Bali conference, there was a lot of talk about transferring technology to the emerging markets to address climate mitigation practices. But this has raised some concern amongst industry regarding a possible duplication of what's happened with the pharmaceutical companies, in which some IP issues raised and violated. And I'm wondering what you were doing with respect to the IP regime surrounding clean technology. You mentioned an initiative to advance financing for the export of clean technologies, but I'm wondering about the IP regime and the potential for a weaknessing or breaking down of that regime. Thanks.
Yeah, foremost, I think it's fair to say we are strongly committed as a government in the spirit of maintaining open and competitive investment markets to intellectual property protection. But technology transfer is important. I mentioned one vehicle. It's this initiative launched by the President, really headed up day in and day out by Secretary Paulson at Treasury, this Clean Technology Fund, which of course will be respectful of IP rights, but also make available on some sort of concessionary basis, and the rules of this have yet to be fully detailed, those technologies to countries in need. Another part of certainly the U.S. Discussion or contribution to the sort of the post-Kyoto climate discussions, which are ongoing through the major economies process, through the UN Convention on Climate Change, is to recommend a tariff regime, a tariff-free regime in climate-friendly goods and services, i.e. reduce tariffs, which would then, of course, mitigate or reduce the prices and make more accessible those goods and services to countries, both developed and developing alike, who need those technologies.
Could you comment briefly on the recent conflict, if you will, between the use of ethanol and obviously corn as supplying that, and the run-up in commodity prices worldwide? That's governmental policy is encouraging the use of that, which then increases food costs to third world countries and all over, and the instability that causes.
Yeah, I've seen different studies on that. This is a subject of much discussion and analysis as we speak in the international development community, so what the precise facts are, et cetera. The facts of the U.S. legislation is we have of that 36 billion biofuels mandate, some 15 billion gallons is related to traditional or corn-based, corn and sugar-based ethanol sources, of which I think production now is at 8 billion. Studies indicate there are a variety of factors in the rise in global food prices, one of which is certainly biofuels production, which is why every effort is being made through the technology research that we as a government are doing, that you or some of your companies are doing in the private sector, to move quickly from these sources of biofuels that can be used for food or human consumption to non-food or human consumption sources of input. This would be cellulosic ethanol, et cetera.
Yes, my question is with respect to Russia and the Caspian states. Looking from afar at the recent Caspian States Conference, in which the Russians asserted that all states must agree to any international activity in the Caspian, this being perhaps a pretext for a Russian assertion of sovereignty over the whole Caspian and the prevention of a trans-Caspian gas pipeline. All these activities seem profoundly hostile to the interests of the Caspian gas exporting states, including Iran. When coupled with the Gazprom purchases of energy assets in Europe, it looks more and more like a Russian monopsony looking eastwards, and a Russian quasi-monopoly looking westwards, and a selling monopoly to Europe. How are the states in the Caspian where you've recently visited, how are they dealing with this? Because publicly they raised no objections to these, what seem to me very bold Russian assertions in that region.
Yeah, I keep in mind that that was one conference at a particular point in time, and Russia is one, albeit a large one, of a number of countries that border on the Caspian region and have a say in these matters as to allocation of resources in the Caspian Sea. Certainly, in our engagement with countries in that neighborhood, border on the Caspian or have access to it. I mean, these are individual nation states. Each have their own special history and relationship with their neighbors to the north and to the south, and they're acutely aware of their independence, which they guard, and want to work and maintain both politically and economically within the context of the region in which they live and the world as they see it.
Okay, well, thank you very much. So you were all so patient and came so on time this morning that I'm going to change the schedule slightly so we can all have a cup of coffee with our keynote speakers. So I'm going to have a short 10-minute coffee break right now. And so come back at 10:25 and we'll present the findings of the study.